Hello, everyone. Welcome to the Finance Burrito, a weekly podcast presented by the Finance and Investment Cell of Shahid Bhagat Singh Evening College. I'm Pratham Agarwal, project head of the cell, and I am your host for today. And we will be talking about millennial investment. Today, we have with us someone who is a FRM professional and a chartered accountant who has held a rank. He is an investment banking professional who has performed various functions in his career while working as a senior analyst for corporates like JP Morgan Chase and Company. And currently, he's working in Goldman Sachs. So please welcome one and only Mr. Prashu Goyal. Prashu, we're so glad to have you here.
So yeah, thank you, Pratham, for this opportunity. Like, good afternoon, good morning, good evening, everyone, like wherever you are. So basically, like Pratham has provided me this opportunity to share my view or thoughts on the millennial financing or any other thoughts I can share with you with my current experience or my prior experience related to the investment banking or the finance or the auditing role I have conducted here in the investment banking with Goldman Sachs and JP Morgan Chase or Yes Bank I have. So yeah, Pratham, thank you for this opportunity and the whole team of Shahid Bhagat Singh College. Yeah, thank you.
Okay, so without any further delay, let's start with our first question. Are we ready, Prashu?
Yeah, sure.
Okay, so from the age when we start earning our income, we sometimes feel like we should start investing our income into the stock market. People used to think about it earlier, and they still think about it. But my question for you is, how do you differentiate in the methods of investing? Like how investing in the stock market used to be before, and how it is now, from your perspective.
So, Pratham, it's a very good question. Like, I'll tell you my personal example. I started investing in stock market 7 to 8 years when our article shipped. So I opened my Demat account. I don't know ABCD about the stock market. So first of all, as a recommendation from my side, you will first of all need to understand that what are the various type of products are there in the stock market. There is one derivatives market which holds the futures, which holds the options, which holds the forex markets, and other interest rate swaps are there, currency swaps are there, and other products or strategies are also there in the market. And then you had the debt market, then you had the money market, and then you have the mutual funds, which is also there in the which is also there as a part of the stock market. So you first of all need to understand that what are the various type of products in the stock market, which so that you can accordingly invest in that. And then you need to understand uh, basically what we do as a part of our initial career, that we just started doing the intraday in the stock markets.
Yeah.
Whenever the stock is going up and down, we are just if the stock is going down, we are just maintaining the short position and squaring it off at the end of the day. But that is not good. You need to understand that speculative position is a different thing and the investing in the market is a different thing. Okay, you need to first of all understand your risk criteria. There are three type of risk. Risk averse. The person is either a risk averse, moderate, or the risk aggressive person. If you are a risk aggressive person, then you are maintaining you towards the speculative market. But that is again not the preferential criteria for any person. Speculative market will provide you the more risk, okay, the more uh, danger to your products, to your finances. And another one, it is a very like you can say you will not create a profit in the long run. Okay, and investing in the stock market, you will provide a basis to your fundamentals. You will need to understand that what is PV ratio, how the stock is calculating based on the book value per share, how the market price of the share is calculating. Okay, how the candles you need to read to invest in the market. I'm sure that you are aware about the reading of the candles, how the candles are there. Okay, so the fund basic based on the fundamentals, you will be able to understand then how you need to first of all invest in the market. Investing in the market is not a bad for any person. Like what our parents told us that you should be away from the stock market. You should not invest in the stock market. But if you will see the investment banking like the JP Morgan Chase and the Goldman Sachs, they are earning billions of dollars in a day only through
Yeah.
the stock markets, and they are running the countries, and they are running the countries like US. Okay, they are maintaining the asset balance of a $3 trillion, which is more than the GDP of India, which is only $2.7 trillion. So you need to understand that investing in stock market is not bad, but you need to understand either you need to speculate yourself through that position, or you need to invest in that. From my initial career, I have started with investing only rupees 500 rupees, and then I have gradually opening it up, and right now it's in millions. So that's how you need to understand it. Am I able to answer your question?
Yes, Prashu, that was really insightful from your perspective. And given that you used to invest 500 rupees in the beginning and then you gradually increased the amount
Exactly.
for investment, that was really insightful.
I can tell you one story also. I've lost my whole salary doing the intraday trading because I was early in my careers, because I was just maintaining the short position. At the end of the day, the stock price is going up, and you need to square it off at the end of the day. Otherwise, it will go into the option trading. You know about the option trading? If
Haven't heard about it actually.
basically, I'll tell you what's that. If you are maintaining the short position at the starting of the day, and at the end of the day at 3 or 3:30, you are not squaring it off your position, then the auction, then the you don't have the shares, and you need to sell those shares to the another person who is on the exchange. Then and then the auction trade will happen at the rate the stocks will sold at that auction. You need to pay that price to that other person, and that will create a huge loss to you.
Oh,
Okay, so from my side, you need to stick to your fundamentals. You need to understand that what's the PV ratio, how the candles are moving, okay, how the market price to book value price per share is calculating, how the ratios are maintaining, what are the financials of the shares. You need to stick to the news also. And the most fundamental example is the going concern. You need to maintain the going concern example
going
of any
concern.
any other company. You will in 2 to 3 days back, you must have heard the news of Vodafone Idea. The going concern is in danger. Why? The non-executive chairman who is holding the 27% shares of the Vodafone Idea is ready to sell its stock to the government or to any other person. Then where the 30 crore users will go, and what will happen to the equity stockholders who is holding the stocks, and what will happen to the debt holders? Okay.
Okay, moving on to the next question. Now, I'm sure you must have heard about the DIY models of investment into stock markets. Like it's becoming a trend these days. So, for someone who's learning the basics of stock market and wants to know more about the model, so could you please give some insights to us about it?
So yeah, it's basically a difference between the traditional type of doing the broking and a new concept which is coming up based on the new organizations which are coming in the market, like the Zerodha, the Upstocks, the Angel Broking and all. Basically, DIY model is nothing but it is a do-it-yourself model. You have to do it at your own. Okay, you have to manage your funds at your own. You need to maintain your portfolio at your own. You need to buy and sell the stocks based on your own judgment. So it's completely based on your judgment. So it's very much linked to my first answer. You need to first of all understand your fundamentals, then you will be able to do your and you will be able to manage your portfolio at your own. Then the concept of do it yourself model will come up into your investment. Okay, so what the Zerodha is providing? Zerodha is only providing you an online platform where you
Yeah.
can buy and sell the shares. Nothing, they are not managing your assets. They are just as a custodian. You know the custodian, and what is the difference between the custodian and the asset management? So I'll tell you. So earlier, what happens, like you have heard the name of Sheikh Khan.
Yeah,
So
Sher Khan.
yeah. So what the traditional investors do, they just open an account with the Sharekhan or with any other broker. So they will guide on the day-to-day basis that what stocks you can buy or sell at the current prices. For that, they charge and earn the money, like 10,000 per month or 20,000 per month. And apparently, they are also providing the platform to purchase or sell the stocks. So right now, what the Zerodha and Upstocks and Angel Broking are providing, they are just providing a zero fee or a negligible fee platform where they will only charge a negligible amount of fees to sell or purchase the stocks on their platform. So that is playing the role of a custodian. They are just the custodian of our assets. And what the share Khan is playing the role, they are managing our assets, which is the main earning of the global investment banks like Goldman Sachs and JP Morgan. If you just read the financials of these investment banks, they are managing the assets of the wealth of the various like richest persons in the world. They are just managing the $1 billion of their funds because they are charging a fee for fee on that. But right now, the do-it-yourself concept is coming up where they are just providing an online platform. So we need to be very much cautious while running these platforms because we don't know the ABCD about the stock. So first of all, you need to be very much stick to your fundamentals. What they are providing as a current scenario in their DIY models, they are providing the candles. How these candles runs. You can there are a lot of videos in the YouTube. You can see that how these candles work on the platforms. They will provide sometimes the candle is going up and on a bulk basis and the line will comes up, so that will show the resistance level of that stock, and then again the candle will go down and will provide a resistance level so that you can understand that the stock will move into that bracket.
Yeah, so how do you rate on the basis of riskiness the DIY model as compared to the traditional method of of investing in stock markets?
Again, you need to understand, you need to calculate your cost benefit analysis for that. Suppose if you are investing 1 million in the stock market and your expectation is something to earn like 20% a year in the from that investment, so you are earning 2 lakh rupees, and to that and to managing your asset you are paying suppose 1 lakh rupees to the traditional broker. So ultimately you are earning 1 lakh rupees, that is 10% of the total investment, which is quite good in the current scenario. And if you are investing $1 million and you don't know anything about the stock market and you keep on losing your money, then DIY models fails, very much fails. But if you are investing only 50,000 rupees, so then why you need to pay a huge amount to the traditional broker? Then the DIY model comes into the picture. So DIY model is basically for a type of investors, or I can say for the students who are like who can't invest so much in the stock markets. But the traditional broker is basically for the millennials, for the
Okay.
millennial investors. Okay, so I'll tell you one example. Like the investment brokers, if you read the financials, there is a column called so there is a line of business in their balance sheet, which is the asset management and the wealth management. So that is related to this DIY model. So what is asset management and another what is wealth management? Wealth management is just another example of the maintaining the trust funds of the of any trustee. Suppose in US what happens like in my like I am getting $1 billion from my father. Manage my fund, then I will provide $1 billion to the Goldman Sachs, and they will manage the funds. And how they will manage the funds? They will not only invest in the stock markets; they will either purchase a whole city and acquire all the plots, or run the whole city from themselves, and then they will earn some amount of like earnings from that city, and they will, after deducting the charges, they will provide that investment to the to the trustee. So that's a wealth management business. Asset management business is what I have provided to you. So another example of asset management is the mutual fund.
Okay. That's again really insightful. So now, coming to the next question. Well, all of us are aware of the current rate of inflation, given the example of Nifty 50 recently crossing that 16,000 mark. But talking about the millennials who are currently running in debt, should they still think of an investment?
Again, it's a very, very, very good question as per the current scenario. First of all, you need to understand that what is inflation, how you need to calculate the inflation, which drives the inflation. So basically, there are various monetary policies which has been in place in by the RBI to drive the inflation. Inflation is only and only 99% of the inflation is driven by the government or by the regulatory authorities. So right now, we don't have the money in the market.
Hmm.
and we need to pump in the whole money into the market so that our economy will boom and our GDP will also come into the better picture.
Yeah.
Okay, so so they are just reducing the loan rates. They are, so you must have heard that repo rates are decreasing and the housing. So that's why the housing loans and the loan charges are also decreasing in the market, and you are able to get the loans at a very cheaper rate of interest. So that is because of the rising inflation or the monetary policy being implemented by the RBI. So they are just pumping the money into the market by lowering the rate of interest. So that's why the people are getting the money, and so after they are getting the money, the demand will automatically will push up, and the supply will go down, and the inflation will also go up at the same rate of interest. So that's why what is happening. So comparing that the current inflation rate is very high. So how the millennials with the debts should invest in the stock market? So that's your question, correct?
Yeah.
So okay. So the perfect example for this in the current scenario is the Adani Group of Industries.
Hmm.
Okay. So they are the millennials, but they have the huge debts, something more than 50,000 crores. Okay. In the
Yeah.
current scenario, also the stock prices are also going down. The Adani Green, the Adani Power, the Adani Ports, everything is going down. So what they should consider, what their fund managers should consider, they first of all need to understand that what's their risk calculation. Either they want to be risk averse, either they want to be risk aggressive. If they want to be risk aggressive, because in the current market scenario, they can take the loan at a very cheaper rate of interest. They can take the loan at a 6 to 7% rate of interest. Okay, so why don't you take the loan from the market at such a 6 to 7% rate of interest and invest it directly into the stock market very due diligently, from which they can easily earn 10 to 15% in a span of 2 to 3 months. So that's a very good investment, and that's a very good like if you will consider the cost benefit analysis also, you are directly earning uh, what, like something around 9% by just earning by just taking the loan from the market and invest directly into the stock market. So that again depends, like how a market is being trending. If we are getting the cheaper rate of loan from the market, if we can directly earn our funds, like by investing those funds into the market at a very good amount of return, then why should not? But again, on that concept, like government has imposed on some of the restrictions. You can't invest more than 20, like on NBFCs and into the banks, you can't invest more than 20% into the stock markets because that's a public money. Okay,
Yes.
then the capital ratio, then the capital adequacy ratio also comes into the picture, where you need to maintain the capital adequacy ratio based on the risk weighted assets to maintain your stress capital. Okay, suppose if the stock market will crash 20% in a day, so you should have the buffer capital to maintain your debts, and you should have the sufficient amount of capital to to return your amount to the public. Suppose if you are aware, like 10 to 12 years back, so there is a rumor in the market that ICICI Bank is going down, and there is
Yeah.
a rush
There
into
was
the
a rumor.
branches, that there was a rushes into the branches, that everyone is pulling out their money. So banks can't deny. So you need to maintain that buffer capital so that in any scenario, in any stress scenarios, you need to return that money to the public. So that's a capital adequacy ratio you need to maintain. So millennial will that's how they need to invest that money into the market. You need to first of all understand your risk. Then first of all you need to understand that what is the trend in the market, how you can return, how you can earn your money from that cost benefit. Okay, the third is the regulatory restrictions, and the fourth one is the capital adequacy ratio for the financial institutions.
Okay, again, I've got my questions answered. Thank you. So next question is we hear about equity shares and equity mutual funds on regular basis. Like being a commerce student, but how do you suggest for investing aggressively in these securities, that is equity shares and equity mutual funds?
Okay, so I'll give you a very traditional answer for this. I came from a Marwadi family, and from my
Okay.
very birth, my fathers told me that from your initial to your in your initial career, you need to maintain how much? 40, 30, and 30 ratio. What is 40? 40, you need to invest very aggressively.
Hmm.
30, you need to be very careful, and 30% is for your expenses. And then
Expensive.
when you are more than 30, when you are more than of your 30 age, you need to cut it down that 40% into 30%, and that 30% should be increased to 35%, and then that should be your like 30, 35, and 25. 35. So you need to maintain your ratio based on your risk, based on your current expenses, and based on your responsibilities. So investing your money into the stock markets or either into the equity mutual funds, I will tell you that you should invest like as you are in your early 30s or early 20s.
Yeah,
Okay,
I'm in early 20s.
you could invest at least 40% in your stock markets because you don't have the responsibilities, and you
Yeah.
can. And the equity mutual funds, from my perspective, comes under the second stage, because those funds are managed by the portfolio managers or the professional managers. So those are quite safer than the equity investments into the, and which is directly into the stock markets. Okay, and again, into those equity mutual funds there are a lot of other, like that are there are a lot of other segments also: small caps, large caps, mid caps, debt funds, digital funds. So small caps again is very risky, large caps is quite safe, blue chip funds is quite safe, segment funding is quite risky. You need to again materialize that how you are investing. The finance, or the all the dots of the finance are connecting with one dot, that is risk. What is your risk appetite?
Okay.
I think I answered your question, or you do you have any other questions on this?
Well, there's a last question. Like, uh, when we talk about financial crisis, especially when it comes to the recent COVID crisis that eventually caused financial crisis, given that the GDP of our country slowed a lot, like by minus 22% in the previous financial year's first quarter. Now, how do emergency funds play an important role when it comes to investing in stock market during these times?
I am completely against of using the emergency funds into the stock markets, because emergency funds itself say it's an emergency. An emergency can be of anything: medical emergency, uncertainty, like any unforeseen circumstances comes into your family, like you don't you have like anything like. But again, in using that emergency funds into the stock market will create again a bubble which has been created into the US in 2008 and 2009. That is due to, like, they are using their emergency funds by investing into the CDOs, CMOs, like the mortgage equities. So that's why the US was completely collapsed. And at that time, Manmohan Singh told us one thing, and Chidambaram also told us one thing: why the India is safe in these times. Because India has the sufficient amount of savings, and that is into the FDs, not directly into the stock markets. So that's why India got saved in 2008 to 2010. So as per my perspective, we should not use our emergency funds into the stock market. If we are using, then we are again running for the 2008 to 2010 crisis.
Well, I've got all my questions answered. Thank you so much, Prashu, for joining in. And it was really a pleasure to host you for this episode.
Yeah. Thank you, Pratham. Thank you, team.